All right, this is part market wrap, but part also a little bit of a discussion on how to deal with the endless hyperbole within markets and how to categorize that and assign it a place within your own trading system and trading universe. This pertains to the S&P 500 index and a discussion that I saw take part over the weekend. The discussion in and of itself was talking about Friday's session and the recent run-up in the S&P 500. It made the point that the S&P 500 cannot advance any further because, to use their words, there has been a catastrophic drop in the number of 52-week new highs. The chart that is on the screen at present looks at the 52-week highs and lows of the S&P 500. So it is a direct count. So on any given trading session, it counts the number of new highs and new lows and simply gives you a value. The theory being that an index can only continue to make new highs if the stocks within it continue to make new 52-week highs. At first, the logic of that seems sound. But there is a nuance to that that is missing and that most people miss. The nuance is that indices are weighted. And I will make a bold statement. A good proportion of the gains in the S&P 500 over the past few months have been down to a single stock, NVIDIA. The gains last year were due to a group of stocks, the Magnificent Seven. They have fallen away to some degree, and it is now NVIDIA driving the market, which is simultaneously interesting but also concerning. So the notion that a market can't move ahead without continual new 52-week highs is somewhat misleading. It doesn't tell the entire story. But what I wanted to pick up on was the use of language. The language that used mentioned words like precipitous and catastrophic. To get a better sense of this, I extracted the raw data from this particular chart and graphed it in Excel. You can see at the extreme end of the chart, I have marked the last session there in yellow. So you can see whether there has been a catastrophic drop-off. If we look at it for the periods beforehand, you could say, yes, it is markedly lower. But if we take all of the data in context, and we are back to that notion of context, you can see that it's not unusual. It is not unusual for markets to pause and to hold their ground. It is even not unusual, and this comes as a shock to anybody who's only just started trading, markets go backwards. I know that's a shock to most people, but it is true. Learn a little bit about the history of markets and look at a chart that goes for longer than an hour and a half, and you'll see that I'm correct. So if you look at it in context, it is not catastrophic. It is within the bounds of what we would expect. Also, the movement within the S&P 500 is also within the bounds of what we would expect in terms of the natural distribution of prices given its history. There is nothing unusual about it whatsoever. So the use of words such as catastrophic and precipitous are simply hyperbole. They're just somebody bullshitting who's had too much sugar, because it is not a reflection of the reality of what we're seeing. Do markets go down? Yes. Do they pause? Yes. Do we get an inversion where we are generating more new 52-week lows? Certainly. That happens when markets downtrend. But there is a further question that needs to be answered, and that is, does this have any relevance or usefulness as a tool or a market surveillance instrument that gives us some insight into what is happening in the market? To have a look at that, I've generated this somewhat chaotic looking chart, which is the new highs overlaid over the top of the S&P 500 index. The scale for the S&P 500 is on the right. The scale for new highs is on the left. So the question is there any correlation or match-up between movements towards new lows and movement within the market? And the answer is, well, sort of. When markets stall and begin to drift back, it is quite natural that you would expect not to see a large gaggle of new 52-week highs. That's just to be expected. Likewise, when markets drop and have corrections, you would expect there to be very few. In some instances, zero. And we can see there are some instances in this chart where there were no new 52-week highs being generated for a period. The question, does this tell us anything? And to some degree it does, but unfortunately people look for predictive instruments. None of the tools we have are predictive, they're simply observational, they're telling us a story. So if we go back to the extreme left and the very beginning of the chart, we can see in October, market has slipped. We're getting very few, if any, new highs generated. Market bumbles along and bottoms and then takes off. The period when the market is trending is just noise. Again, we come back to this notion that indices are weighted. So you don't have to have a continual series of every stock making a new high to push the index along. And this is a thing to note with indices. This particular characteristic makes them different to dealing in shares. You're dealing with a population, not a singularity. So you have to understand the dynamics of the population. In terms of generating highs, which is what people want to know, because people are concerned about markets pulling back, we come back to this old notion that people think that they will go to bed one night and the S&P 500 is 5,800. They'll wake up the next morning and it will open at 2,400. That doesn't happen. And once again, if you become a student of markets, you can understand how markets unfold. So in terms of, does it offer us any market surveillance that is, I'll say, useful? The answer is maybe. Maybe. It gives us a sense of the internal health of a market. Quite naturally, when you're an index trader, you want to see the index making new highs. Likewise, as a position trader in equities that make up the index, you want to see them making new highs because that is a sign of health within the index. It is a sign that you are getting instruments trending, which offers the opportunity for profitability. So if we come back to the index and we take a longer view, again, we are back to this notion of context. Where does everything fit within the context of what is happening? If we go back, if we skip back a slide or two, this is a single piece of data. The notion that a single piece of information regarding a market or individual share, unless it is some form of catastrophic left field news, has an impact upon the trajectory of what is happening is utter nonsense. Everything occurs against the backdrop of what is the bigger picture. So we return to the bigger picture of the S&P 500 and we see that since, let's call it September 2022, the market has been trending up. That trend has accelerated year to date. As per habit, I've run a filter along the bottom. Green good, red bad. Green is good if you are an index trader and if you are trading the population of shares that make up that given index. That remains green. From my perspective, from the way I see the world, so long as that remains green, I'm a buyer of stocks within the S&P 500. Likewise, if this was the NASDAQ 100, I would be a buyer of stocks within the NASDAQ 100 if it were green. If it was the ASX S&P 200, I would be a buyer if it were green. So our single piece of information gets somewhat washed out against the backdrop of the reality of what is happening to the market overall. So a single piece of data is akin to someone driving by and yelling something out the window. It's there and then it's gone. It doesn't mean anything without understanding how it fits into the overall picture. You can even simplify this and you can make your life in trading as simple as you want or as complex as you want. Sadly, people want to make their lives as complex as possible, which I don't really understand. This is just a midterm moving average. Again, prices above good, prices below bad. It's very simple. It's very binary. It does not require any form of interpretation whatsoever. So it is simple, and the simpler something is, the less friction it has. The less friction it has, the less error points there are within the decision-making process that revolves around this tool. This is also given added weight by the fact that this is a weekly chart, so there's a lot of information in here and a lot of the noise is washed out. But if you are an index trader, and here's where the trade idea comes in, we step down to a daily time frame. This is a mid-term moving average again, so we get a sense of the overall trend. We see a series of tradable long trends in the index since November last year. Large one that runs from November 23 to about April 24, picks up again in May, runs to August. There's a little bit of noise, that's not really tradable. Market accelerates again in September, October, and we are where we are now in this small congestion zone. So what is the trade idea? As I've said before, congestion zones are not things to be concerned of, nor are they things to be preemptive about and guess, because they give us a traffic light style of trading signal. That is, when you get a movement above, by whatever margin you choose, it is a signal to go long. I will mention I don't short indices. Whenever I have brought short selling of indices or index products or shares into a trading system, for me, the performance collapses. There are undoubtedly people who can do it. It just doesn't work for me. I don't see the gains that I would presume to be necessary for me to make it worthwhile. So returning back to our chart, we have this small congestion zone, a series of mediocre sessions where the market goes nowhere. We are bounded. So we're back to the decision of what makes us go long. Well, what would make me go long is simply that I would get a break from this congestion zone. Price is naturally above the moving average, so I have a setup that works. The background is in my favour and is conferring an edge to me, and a breakthrough above and beyond this congestion zone is for me a trigger. I like there to be breakouts. I want to see the entire body of a trading session beyond this particular point of resistance. And this is something I mentioned in the Qantas trade. You can pick however you want to do it. Everyone is idiosyncratic in their trading. I like things to be clean and clear and away from noise. To give you an example, if we go back to where the market took off in November, you can see there's a series of gaps, and there is a gap looking at this around about the 13th of November, 12th, 13th. And then the market has a very clean, almost linear run. That to me is a perfect signal because I'm up and away from the noise. As a final point, one of the things that's important to note is try and avoid the desire to be the first person. Let some other idiot go first and create the environment that is useful for you. From my perspective, and this is a corruption of an old Jim Rogers quote. Rogers is a known commodity speculator. His view is he would wait for a trade until the money was literally sitting in the corner, and then he would walk over and pick it up.